Hello viewers, in last video we covered one of the important tools of financial analysis, that is comparative balance sheet. Now in this video we cover another four important tools of financial analysis, that is comparative income statement, common size balance sheet, common size income statement, and trend percentage. Well, as we saw in last video, that comparative balance sheet is basically a comparison of 2 years balance sheet. Same ways for comparative income statement. It is also like comparative balance sheet, which combines information from several income statements. Income statement means the statements of profit and loss account, and that is in a single column statement. And previous financial statements are presented with the latest figure side by side columns. And if I talk about the format, it is exactly the same format that is being followed with comparative balance sheet. And this comparative income statement helps in the following accounting, basically to compare current amounts to past year and to look if the performance have improved or deteriorated during over time. Then to figure out the patterns in the relation to the turnover, that is the sales, and it also calculate the change in percentage. So as I spoke, that it is the same format which is being followed in the comparative balance sheet. That is, you can see here particulars, previous year amount, current year amount. Then you have to calculate absolute change. That means the change between the current and previous year. And finally, percentage change. That is absolute change divided by previous year multiplied by 100. Now the format which is being followed is comparative income statement. It lays total emphasis on turnover, that is sales. So this format is being recognized by many of the accountants as well as many of the statutory bodies to be followed for comparative income statement, because its relevance is also in the one of the important tools, that is ratio analysis. So right now we focus on comparative income statement, in which first sales are being recorded, then you have to subtract return, that is sales return. Then it gives you net sales, that is sales minus returns or debit returns. Then you have to subtract cost of goods sold. Cost of goods sold is basically the cost which is being incurred on the production of a commodity or service. So when net sales are being calculated, the next step is to deduct cost of goods sold from that net sales to arrive at the figure that is called as gross profit. And in this gross profit, the indirect expenses and indirect incomes are to be considered, which are also called as operating income or operating expenses. If I talk about here, indirect expenses in a simple way, or as a layman, indirect expenses are those expenses basically which are beared for selling of a commodity, or in a simple way, it is office expenses. In cost of goods sold, the expenses which are considered are termed as manufacturing expenses or factory expenses. But indirect expenses are those expenses which is being beared by an organization in an office. In a simple way, the following examples you can use for indirect expenses like rent, salaries, discount allowed, depreciation. Now, depreciation is now being excluded indirect expenses in the recent accounting standards. Then indirect incomes are the incomes which is being generated by an office. It may include discount received, rent received, and so on. Commission received is also one of the important examples of indirect income. Then when you subtract indirect expenses and add indirect income with gross profit, the figure arrives is called as EBDIT, that is earning before depreciation, interest and tax, or profit before depreciation, interest and tax. Here we follow the same pattern for the previous year, current year, absolute change and percentage change. But this format is being important, that is started with sales, subtracted returns, arrives at net sales, then cost of goods sold is to be subtracted from net sales, gross profit will be achieved, then indirect expenses, subtract indirect income expenses, subtract indirect incomes will be added, then the figure is earning or profit before depreciation, interest and tax. Out of it, this first depreciation, that is the wear and tear of fixed asset, is to be subtracted. So the figure which is being achieved is termed as earning before interest and tax or profit before interest and tax. In many of the solutions, this depreciation is included in indirect expenses, but as I told you, that now as per recent standards, EBDIT is to be separately calculated to know the relevance of depreciation, which is an internal source of finance. That is another topic. Here we lay emphasis on these things. So earning before interest and tax or profit before interest and tax means now the first step is out of this earning or profit, interest payments are to be made. Interest payment, that is basically fixed charge which is being to be beared by a company. It may be interest on debentures, interest on bonds, or interest on loans or long-term loans. So interest payment, that means which is to be paid to the outsider, that is being subtracted from EBIT. Then the figure which is achieved is nomenclature is EBT or earning before tax, or PBT, that is profit before tax. And finally tax is to be paid, which is termed as sometimes corporate tax, or some in solutions you will see some it may be termed as income tax. So that tax which is to be paid to the government, or it is a compulsory transfer payment, it is the final payment for this format. Finally, the figure achieved, which is to be achieved, is called as EAT, that is earning after tax, or PAT, that is profit after tax. So the main relevance of comparative income statement is to calculate this earning or profit after tax, or to know the relevance of sales in this earning or profit after tax. Now next, tool of financial analysis, common size balance sheet. Well, it is a balance sheet that displays both the numeric value and relative percentage of total assets and total liabilities, or you can say equity accounts. Means here you don't have to basically compare the actual or current values with the differences, their differences, as we had done in comparative balance sheet. Here the basic main aim is that which is to be for internal reporting, and generally these common size balance sheet is basically prepared to know the relevance of particular fixed asset or current asset or current liability or fixed liability in the total of balance sheet. So comparative balance, common size balance sheet allows for the relative percentage of each individual asset or liability, and which is to be analyzed. And they are generally, as I told you, that it is being prepared for internal management, and they provide very vital information to sometimes to external auditors or parties also. This is the format of common size balance sheet where we started with. This is as per Companies Act 2013, the format of balance sheet. Here each individual asset and liabilities appeared with previous year, current year. And here the percentage here means the percentage of an individual asset or liability in the total of balance sheet. Whatever the asset and liability for that year, it will be divided by the total of that balance sheet to arrive at the percentage of that individual asset or liability in that particular year. So as I told you, their main aim is to know the relevance or what the importance of particular asset or liability in total balance sheet. The next is common size income statement. Well, it is an income statement in which each item is expressed as a percentage of the revenue, as a percentage of revenue or sales. In common size balance sheet, the percentage is to be calculated of total of balance sheet, but here is the percentage of total percentage of basically revenue is to be calculated. So what is the relevance of individual item which appears on the format of comparative income statement are same in the comparative income state, common size income statement, but here the major emphasis to know the percentage of that particular item in the total revenue or sales. So this common size income statement are based on consistency and compatibility of financial statement, and this common size income statement makes it easier to see what is driving a company's profits, and also helps to show how each item, as I told you, each item or component affects the financial position of a company. So as a result, the financial statement users can easily compare the financial performance to the company's peers, and this common size financial analysis also apply to the balance of cash flows also. This is the format of common size income statement as per Companies Act 2013. Here the revenue from operation, that is net sales, is to be calculated, other income, and each item is calculated with a percentage of sales. Whatever the cost of material consumed, purchase of stock, change in inventory, finance, depreciation expenses, all these expenses, either expenses or income, are to be calculated with the percentage of sales. Means the individual, say take an example of expense, individual expense will be divided by the total sales and multiply by 100 to know about the percentage of its share in the revenue. So either it is profit before tax or profit after tax. Again and again, I'm telling you the percentage in of total revenue of that particular either profit after tax or before tax is to be calculated. Then the last topic of this video is trend percentages. As the name suggests, trend percentages means the trend which is being followed, and this trend is generally not of past only 1 or 2 years, minimum of 3 to 4 years trend is being calculated, and it is sometimes it is also referred as an index number in especially in statistics or economics, and which helps to compare the financial information from time to time over a base period. Base period means the previous year sometimes, or the 0 year is also called as base year. And trend percentages are calculated by a simple formula. Once the base year being selected, the current year amount will be divided by base year amount and multiplied by 100. So the weight of 100% given to the base year financial statements. This is an example of a trend percentage. Here the base year is 2000. So this base year trend is being 100%. Means 1500 by 1500 gives you 100%. So either it is sales, stock or profit, it will be 100%. For 2001, the amount of particular year, that is sales, will be divided by 1500. For next year, the amount of sales divided by 1500 means for each year, either it's 2001, 2, 3, 4 or so on, the present year value will be divided by base year value. And to calculate percent, it will be multiplied by 100. So either it is a sales, stock or profit after tax. This is how trend percentages are being calculated. And trend percentages are, there is no basically specific format to calculate trend percentage. Sometimes there may be to calculate the trend of current assets, sometimes maybe to calculate the trend of fixed assets, or profit revenue system or revenue from operation, like as given in the example sales. Sometimes it is to be calculated of liability, but generally trend percentages are lay emphasis on the asset side of balance sheet. Well, that is the end of this video. Next, we will cover one of the most important financial tool, that is ratio analysis.